The common wisdom in the financial space is that we should buy the index, buy the entire S&P 500, because buying individual stocks is extremely dangerous. Just be diversified, take advantage of the long-term appreciation of the market as a whole. Now, my data says something different. Buying the entire index is not the optimal strategy. Because think about it, it seems to be quite marginal. Why is it the S&P 500 and not the S&P 100? Right, with the Nasdaq, we've got the Nasdaq 100. Why is it not the DAX 30? So in Germany, it's only 30 stocks in the index. How many companies should actually be in an index to have the best risk to reward? If you look at historical performances, if you look at historical risk, how much the prices go up and down over time, what's actually the best risk to reward? Is it really the S&P 500? Or is it the S&P 100? So just buying the top 100 stocks. Or is it the S&P 10 or the S&P 5? Can we get away with just buying the 5 largest stocks and still have the same performance, maybe even more performance? How does then the risk change? Let's have a look at the data. I used artificial intelligence to write a program to make exactly that kind of analysis for the S&P 500. You will be very surprised. And here is that application. It starts the data in 1990. And what we see over here, that's the S&P 500. So price change plus dividend payments in orange, and what we see in blue, that's the S&P 1. Now this is a logarithmic scale. On a linear scale, the difference is massive. If over those 36 years you bought the S&P 1, you only bought the largest stock with 100% of your capital, you would have turned $100 into $39,000. If instead you bought the S&P 500 and we assume zero management fees here, you would have only gotten $4,000. So it's almost a 10x difference over that time. The annualized performance goes to 17.5% instead of just 10.5%. Now that's of course just part of the puzzle, right? We can't put all of our money in a single stock and hope everything will be fine. Obviously, diversification to a degree makes sense. But how much diversification, how much more additional risk do we actually get by buying only one stock versus 5 stocks versus say the top 10 stocks in the S&P 500? What's really the ideal scenario for our stock exposure? Now I'm saying stock exposure here because it does make sense to be diversified across asset classes. People get this wrong. Let me show you what I mean. People think that you get a lot of diversification by owning different stocks. So you've got stock A, you've got say stock B, you've got stock C, and you've got all of those stocks, and in the end, because you own all of those stocks, the random fluctuation across those stocks cancels out and your portfolio line will be much more steady. You will have more steady price appreciation. That's the idea of diversification. You get the same kind of reward with less risk, with less volatility. Your volatility moves from very high to rather comparatively low. The problem of spreading the risk across different assets, the problem with diversification is that it's dependent on the correlation. In other words, how much do two assets move in the same direction at the same time? And if you've been following crypto for a while, if you've been following the stock market for a while, you see that sometimes we've got days where all of the stocks or all of the cryptocurrencies crash, and then other days where all of those assets go up at the same time. So within a market, we've got a lot of correlation. Within the stock market, all the tech stocks go up and down at the same time. And within the crypto market, all the cryptos go up and down at the same time. The correlation is high. However, if you buy things in different asset classes, so you've got stocks and crypto and property and precious metals and bonds, you've got different asset classes that you diversify into, then you do have the diversification benefit, because across asset classes there's much less correlation. So it does make sense to own all of those asset classes. It does not make sense to buy 500 different stocks. But how many stocks should we own? How much more risk do we introduce into our portfolio? Again, this is the S&P 1 versus the S&P 500. Here on the left, we see the annual outperformance. How much does the S&P 1 outperform or underperform in a given year. And this already looks quite good, right? Most years we do see outperformance. The magnitude of those outperformances is also very large. We've got 50%, 60% even. The years of underperformance are rather muted. The maximum underperformance in a year was minus 27%. Of course, over time, the best stock changes. It used to be General Electric, then it was Microsoft for a year, then it became ExxonMobil, Apple, etc. Currently, it's Nvidia. So this application simply just looks at the largest asset at a particular point in time, and then when the year changes, just rebalances. So it doesn't even look at rebalancing within the year. It doesn't even do this all the time. It just does it once a year. This is also ideal for tax purposes potentially, right? If you have to pay taxes on your short-term capital gains, a one-year holding period is exactly what you are after. And this is what this backtest, what this simulation is using as an approach as well. Here are a bit more details around that particular backtest, what happened in a particular year. And here's a summary I will get to in a second. But have a look at this comparison first. Of course, we've already seen how the annual return is much higher for the S&P 1 versus the S&P 500, but also our volatility, unfortunately, is higher. So we do have more risk. In other words, we are buying rather this shaky thing compared to the more steady thing. And that's not necessarily good, right? We don't want volatility, especially if we're not interested in timing the market. The Sharpe ratio, however, is still higher. In other words, the additional risk that we are buying does get overcompensated with more performance. We get more performance relative to the additional risk that we take on. The beta of the S&P 1 versus the S&P 500 is 1.15x. So that's the inherent leverage. If you were to buy the S&P 500 with a 1.5x levered ETF, you would pretty much get the same volatility compared to just buying the S&P 1. But here's now the question. Should we buy just the S&P 1 or the S&P 2 or 3 or 5 or 10? Let's make the same kind of analysis across different S&Ps. How much diversification within the stock market makes sense? Here we've got the different Sharpe ratios for the different S&P 500s. We've got the different returns. We've got the different volatilities. But since tables are ugly, we've also got a chart. Let's zoom into that chart and compare. The S&P 500 is here on the left. The S&P 1 is this over here. The S&P 5 is this over here. The S&P 20 is over here, etc. So the annualized performances of all of those strategies is much higher compared to the S&P 500. Now, how does this work for us, let's say, the S&P 2? So we take the S&P 2. At any point in time, we've got two holdings. Now, those two holdings have different weighting. That weighting is dependent on the market cap. So let's say, in this case here, Apple is larger than Microsoft, and 60% of our portfolio is in Apple, only 40% is in Microsoft. The vertical lines again show us when one of the assets gets moved out. So in this case, Apple and ExxonMobil gets replaced with Apple and Microsoft. And that then recently got replaced with Apple and Nvidia. So that's how that works. It's the same for any other composition. So let's say the S&P 5. At any point in time, we'd have the top 5 stocks based on their market caps. So let's get back to the summary chart. The annualized return is higher for pretty much any of those sub-indices compared to the S&P 500. This tells us if we buy, let's say, the S&P 20, we get the vast majority of returns. And if we buy the bottom, right, the S&P 480, but the bottom 480, we get much less return. So the 480 smaller stocks are dragging down the performance of our top 20 stock holdings. Isn't that fascinating? So this is now just return. Have a look at volatility. Of course, volatility also increases. But what I find fascinating is that once we take the S&P 2, we're already relatively low on volatility. And then we have to go all the way down to the S&P 15 to reduce the volatility more. So yes, we do get less volatility by buying the S&P 500 that has only 17% annualized volatility. But really, you're watching a crypto channel here. So if you're okay with 25 or 26% annualized volatility for much, much higher returns comparatively speaking, then that's probably the better approach. What about the maximum drawdown? Again, we just look at the data points year to year. We're not looking at the drawdown within the year. We don't necessarily see that a more concentrated portfolio is that much more risky. Yes, we did have more drawdown with the S&P 1. That was 51% in the maximum. And the S&P 500 had only 37%. But already with the S&P 2 or the S&P 3, we have even less of a maximum drawdown relative to the S&P 500. Here's a more academic way to look at things, the Sharpe ratio. So the risk to reward, it looks very good for the S&P 2. And here is the beta, how much risk are we taking? Interestingly enough, if we move from 2 assets to 7 assets, we increase our beta. We increase how much the performance fluctuates year over year. So it probably makes sense to have a concentration between 2 assets and 5 assets. Now, I prefer the S&P 3 the most. Have a look at this. This here is the S&P 1. And the S&P 1 again is quite fluctuating. We do reduce our volatility quite significantly and our drawdown from top to bottom quite significantly by going to the S&P 2. And here we can see the vast majority of years we outperform massively. But now compare this to the S&P 3. The S&P 3 tended to have even more outperformance in the last 10 years. So it looks like the S&P 3 recently seems to be the best approach. And I also feel a bit more comfortable. If all of our stock allocation is in that portfolio, owning 3 stocks rather than 2 stocks feels a bit better. And it performs very similarly, as in the annualized return, it's 17.76% versus 18.7%, but our maximum drawdown goes down. And especially recently, it performed better the last 10 years. And that's then how that looks like over time. Again, this is a linear scale. Here is the same on a logarithmic scale. The 2 lines tend to diverge more and more consistently over time, as has already been shown with the outperformance chart. And that kind of portfolio would hold the following right now: 37% Nvidia, 32% Apple, and 30% Google. I like this analysis a lot. And so far I've only done this for the S&P 500. I also plan to do this, say, with the NASDAQ 100 or with other markets, right? How does this behave, for example, in Japan? How does this behave for the Euro stocks? My feeling is that we will see very similar kinds of performance. The winner takes most. What I've been discussing time and time again here about the crypto market, that most altcoins tend to underperform Bitcoin most of the time, it seems to also be the case for the stock market. So the stock market has a few winners and a vast majority of losers. Concentration of returns is a real thing. And that's probably why most people tell you not to buy individual stocks. If you look at the NASDAQ 100 in a given year, right, you've got your 100 stocks, and you check what is the return in that given year. And let's say that given year was very good, it made 20%. And then you look at how many stocks actually made more than 20%. So you're ordering here by the performance in that year. You check how many made more than 20 and how many made less than 20. What you will very often find is that roughly 80% of stocks did less than 20%. 20% of stocks did better than the annual return, 80% did worse. How is this possible? It's possible because returns are concentrated. Returns are not normally distributed. So if we look at the number of stocks and we look at their performance in a given year, this is not what we see. Instead, we've got many losers, many underperformers, and then a few outperformers that outperform massively. And what's so interesting about the analysis that we've made with this particular application is that the winners tend to be somewhat predictable. It seems like the winners are simply just the largest stocks. The stocks with most mind share, the stocks with most momentum, the stocks that currently lead the industry. Think about this. If you are in a particular industry, let's say the tech industry, and you consider what employer should I go to? Where should I sell my work? Where should I sell my labor? The most talented people will, of course, try to go with the largest names. The largest names, the Googles, Amazons, etc. of this world, the Nvidias of this world, they will attract the best talent. everybody that's below that has to work with who's left. And very often it's also the same with productivity, right? There are a few people in a company that churn out the vast majority of output. If you have to work with second-tier employees in the first place because there's a competitor in your space that's larger and that has more momentum, then of course it's hard to overtake this. And there seems to be a lot of those compounding effects that favor the winners. The winners seem to keep winning. And what's also interesting about this analysis is that the top companies in the past, let's say General Electric or ExxonMobil, once they left the top 3, they never came back. So this is a one-way street. And very likely, if we see a rotation again, for example here, Amazon getting out of the index, it's very hard again for Amazon to come back to the top 3. If you have the choice between working for Apple or Google or Amazon, you're probably going with Apple or Google. And so I hope you got some value out of this video. Most people do not talk about this. Most people just tell you buy the S&P 500 and they are too lazy to actually make that analysis. If you got some value out of this, then feel free to send this to other people that are interested in the topic as well. And of course, feel free to also give this video a like. If it's your very first time around here, then feel free to subscribe as well. I publish videos regularly on this channel. And if you're interested how I built this backtest and what kind of backtests will follow, then feel free to also join the premium membership. A link to premium is down below as well. Thanks for watching. See you next time. Cheers.